Hello, everyone, and welcome to today's webinar, Federal Tax Withholding in 2021, Understanding the Changes. I'm Yonina F. Shineweather, CPA, the Consulting Director of Compliance at Viventium. And with me today is Malka Trump, my colleague, CPA, CPP, the Director of Compliance at Viventium. And together, we're here to take a close-up look at what's changing and what's staying the same about federal tax withholding in 2021. A couple of housekeeping notes before we get started. Today's webinar is being recorded, and a recording will be made available to our participants. And I want to also encourage you to go ahead and use your questions toolbar on your webinar toolbar and to type in any questions that you may have regarding any of the material that we'll be discussing today. Also want to mention and to direct your attention to Viventium.com's webinar section, where you'll find a whole slew of useful information webinars pertaining to payroll and HR in 2021. Now, I think the biggest question that we're going to start with is, why are we talking about changes to federal tax withholding if this is 2021? You know, we all know that there was a major revamp of the federal tax, the payroll tax withholding system in 2020. Numbers may have changed a bit, inflation adjustments, cost of living, that type of stuff in terms of the tables. But why do we need a whole webinar about federal tax withholding in 2021? So really, this question can be asked from two different angles. And there may be two different groups of participants today. There's some of you who are avid Viventium followers, and you've already learned that Viventium's offering a webinar. Probably pays to come and see what they have to say, because there's always valuable insight. And so you're not quite sure why we are talking about tax withholding changes in 2021, but you're all ears and you're here to hear about it. Another group of our participants today, I bet, have been getting lots of questions from their employees about what looks like the new form W-4, how to fill it out, perhaps as part of their onboarding process of new hires coming aboard, or perhaps even ongoing employees who are changing some of their information. And these employees may not have yet seen the W-4 changes that were enacted in 2020. And of course, their first stop is their payroll department, that's you, and they have lots of questions. So really, to both of these groups, I say it's true that the federal tax reform or tax withholding was revamped in 2020, but it's an ongoing change that you and the payroll department have to deal with as more and more employees, I should say, are going to need to deal with this new W-4. You may have had maybe one or two new hires that have looked at the new form, but the bulk of your employees, your ongoing employees, have been grandfathered, have been using the pre-2020 forms, but now comes in, a time that they need to make a change to perhaps an address or a name or marital status, and they just want to use the same old familiar short form, and they say, well, I was hired, in 2018 and 2011, why do I have to use this whole long new form? But yeah, they do. Anybody who wants to make any change at all to their federal tax withholding has to use the new form. And so dealing with the questions, the inevitable questions that are going to arise as they complete these forms, that's something that your payroll department has to grapple with. And so it pays, if you've familiarized yourself with the beginning of 2020, it pays to review. And for those of you who never really got familiar with it in the beginning, it really pays to understand what your employees are up against and what they're probably turning to you to help them with. That's what we're here to discuss today. So let's take a step back for a minute. The Payroll Tax Reform, as it was called when it was passed back in December of 2017, was probably the largest piece of payroll legislation, perhaps barring COVID legislation, since payroll tax was enacted, because we've had some big pieces. We've had ACA, but ACA has been limited in its scope. It basically only applied to applicable large employers, ALEs, and only to their full-time employees generally, whereas changes to federal tax withholding affects every employee of every employer of every size in every location and state and in every industry. So it's a very every kind of legislation. And I would venture to say that as daunting and as large as COVID relief has been, whether it's the FCRA credits or the employee retention credits, or for those of you who are eligible for SBA's PPP program, that was big, but it was also limited in scope, whereas federal tax withholding changes, that's something that lands at the doorstep of every single one of your employees. And as I mentioned, anybody who wants to change anything on their W-4 is going to come up full stop with this new form that they're going to have to grapple with. So when did this all start? As I mentioned, it started with a law that was passed back in December of 2017. That was called the Tax Cuts and Jobs Act, the TCJA. Its name is misleadingly short compared to the legislation itself and its impact. But one of the provisions of the Tax Cuts and Jobs Act is that Congress said, look, we have this kind of funny payroll system. It's called pay as you go, meaning we don't wait for people to pay tax in at the end of the year. We're going to withhold at the source the amount of federal tax that the employee owes as they go along. And the way the system traditionally worked is that the withholding wasn't all too accurate. People were most of the time over withheld. And comes year end and people filing their personal tax returns, January, February, March, up till April 15th or so, people would get refunds. And everyone just kind of got used to that. Like, we pay in more in payroll, and then we look for our tax refund when we file our tax returns, which is the reason that most people are in a rush to get their W-2s and get their tax returns filed, because they kind of got used to that they're going to get a refund at the end of this whole system. Comes the Tax Cuts and Jobs Act and said, let's start thinking about this differently. We want to stimulate the economy. We want people to have money, their own money, in their hands up front. Why should we as the government collect it and then once a year give it back to them? Let's tweak the system. Let's make the withholding more accurate. Let's decrease it. Instead of doing a big estimate that gives such a high amount of withholding and have people get refunds later, let's decrease the withholding and thereby increase their net pay. Put the money in their hands prospectively as they go along and put that money into the economy throughout the year so that the refunds at the end are going to be decreased. Now, it sounds good. It was a very good theory. Give people, make their withholding really reflect what their tax liability is going to end up being. Make it more accurate and give them their money up front instead of making them wait. And as good as it sounds, there were a number of employer concerns that went along with that type of logic. First of all, if you want to sharpen the system and make the withholding more accurate, more reflective of the employee's actual liability, inevitably you are going to be making the system more complex. You're going to be needing to collect additional information from employees through their employers, which of course will decrease employees' privacy about their financial situation. It will also place a larger burden on America's most important tax collectors, and those are the employers, because most of our tax revenue comes through America's employers, something to be proud of yourselves about. And it will naturally increase the burden on employers, because essentially what we're going to have to do in order to make this withholding more accurate, we're going to have to change that little slip of a form that was called the W-4 almost into a mini personal tax return, into a mini 1040. That's the form 1040 that gets filed, and it's going to have to include lots more information, a lot more data elements in order to make that withholding more on target and bring it more into sync with the employee's year-end liability. So these were concerns of employers. And the IRS, I really have to give them credit and say they did a yeoman's job of addressing the concerns of the employer community. So much so that originally this law was passed at the end of December 2017. So everyone understood that it wasn't going to be implemented as of January 2018. Everyone needed time to modify their systems, their software, their documentation, education, outreach. But originally, the IRS set 2019 as the launch of this big tax reform, this tax overhaul in payroll tax withholding. And they really were, the IRS really was very responsive and receptive to comments from both the employer community and the payroll service provider community. Viventium was proud to be part of that process. The IRS even launched a private contractor to kind of create a think tank, and they invited input from stakeholders in the employer community. Viventium was privileged to be one of them, and we did participate, and actually a couple of our suggestions that we submitted to the IRS were implemented during the comment process. The IRS kept releasing drafts of the 9-4, of the W-4, drafts of what the system was going to look like. And they were really, really listening to the employer community. But because of these concerns, employers were concerned, how complex are you going to make this? How much information are you going to require employees to disclose to us? What burden will this place on us? Because of all those concerns, the IRS realized that it was not going to be ready to launch this system in 2019. And so still in 2018, they announced that this whole change was being deferred and it would not be launched until 2020. And then early in 2019, again, they began the next rounds of comments and input and drafts until they were good and ready to launch this last year in 2020. And they really, again, they did their best with a very difficult piece of legislation. And as we'll talk about as we go along, I think what you're going to see built into the W-4 is a balance between three variable points. On the one hand, Congress's mandate handed to the IRS to make withholding more accurate. We don't want large refunds. Make it reflect the actual liability. On the other hand, they were balancing complexity and burden on employers. And on the third hand, if you will, they were balancing the damage, the decrease to employee privacy. And they had to come up with options and ideas that could strike an ideal balance, or as ideal a balance as possible between all these three variables. Employee concerns, well, if an employee doesn't do it right on their W-4, they could have a very unpleasant surprise at tax time. They could actually now be left owing money because that margin has been closed up and the withholding is becoming closer and closer to the liability. If they don't figure out how to fill out their W-4 the right way, instead of having a refund, that would be half a problem. The refund wouldn't be so bad, but to end up with a balance due and potential penalties for failure to have enough withheld or to deposit estimated taxes, that's not something that employees are going to be happy about. And therefore, the IRS is encouraging you as the employer to encourage your employees to do what they call a paycheck checkup. There is what they now call the tax withholding estimator. There's a link there on your slide. Oh, by the way, copies of the slides will be available, will be provided to you together with a recording of this webinar. And by going to that location at irs.gov, your employees can put in their specific financial situations, a confidential site, obviously, and no identifying information is needed. They don't need to put in their social security number or their address or their telephone or anything like that. But they can calculate how much tax they should be getting withheld, and then they can adjust their W-4 accordingly. So what you can do to help your employees is direct them to that IRS tax withholding estimator. Now, what you don't want to do, and this is really a best practice that I think most payroll departments need to grapple with, what you don't want to do is become your employees' tax advisors, meaning they may come to you, and since there's so much more data, as we'll soon see when we step through the form, they may say, well, what should I put here? Or like, if I have another job, like, what do I check? How much more should I put down to withhold? Or what if my spouse is employed? Or what do I do? So that's where we cross the fine line between just explaining the form to them and becoming tax advisors. And the best practice is always don't become your employees' tax advisors. You can direct them, and at the end of the webinar, I'll share some links with you that you can direct them to in terms of frequently asked questions and IRS instructions and information, and of course, encourage them to speak to their own tax preparer, tax advisor. But you want to be careful to toe the line, that very thin line between just explaining the form and its instructions and actually advising them. And as we go through it, I'll try to highlight where I would suggest you drawing the line and really not providing them with further information. Another best practice is you want to check with your own payroll provider, or if you're using off-the-shelf software or some type of an internally developed package, and make sure that your software is able to support the two systems that tax reform has created. What we're looking at here on this slide are the two separate sets of tax tables for 2021. And as you can see, one is called the standard rate schedules, and the other is, well, it's called the checkbox rate schedules. There's something that we like to call the magical checkbox on step 2 of the Form W-4. And depending if that checkbox is checked, and also depending on when the W-2 was filled out, if it was pre-2020 or post-2020, you may need to use either one or the other of these sets of tables. So those of you who perhaps are new employers, or those of you who may have switched providers or just not sure, or maybe never really had anyone give you yet a post-2020 W-4, well, now's the time to check with your providers or your payroll partners and make sure that they are capable of supporting both kinds of calculation. Now, one of the things that the IRS created in 2021 was what they called a bridge, or a calculation bridge, for systems that can't deal with two sets of tables. And they want to convert all employees to be able to use just one set of tables. Now, in Viventium, that was never an issue for us because we were ready with both sets of tables from the get-go, from the beginning. But if your provider or your service is not supporting both, then you do want to make sure that they're at least supporting what's called the computational bridge. So just as a best practice, make sure you're in compliance, make sure you're withholding for your employees the correct amount so they don't run into problems at year end and come to you to make them whole. You want to make sure that your provider is either supporting two sets of calculations or at least supporting the computational bridge. So what happens when your employee comes to you with this form? This is it. This is the new form W-4, and it's dated 2021. The 2020 was very, very similar, just some of the numbers have been updated. If you'll notice, the name has changed. Most people don't read the titles carefully. It's now called Employees Withholding Certificate. In the olden days, pre-2020, in other words, from 2019 and back, it was called the Employees Withholding Allowance Certificate. That word allowance has become a bad word in payroll parlance because, as of course you've seen when you've filled out your own personal tax returns probably, there are no withholding allowances, or sometimes they're called personal exemptions, anymore on the tax return. You know, we were used to a system of like single and 3, married and 2. Well, that 3, that 2, that idea of taking the number of dependents that you're claiming and getting a certain amount for each dependent, that doesn't exist anymore. It's not extant on the 1040, and compliantly, you know, correspondingly, it's not extant in the payroll tax withholding system either. So the word allowance has gone from the title, but that's not just the only change. It was kind of out with the old and in with the new. And so when employees come to you, and it could be an employee who's been working for you for 20 years, but right now they need to change their address, or they need to change some other, you know, there's some additional withholding amount that they used to be getting withheld that they want to take off, or the other way that they want to, you know, change the amount of extra withholding, something pretty simple, straightforward. And all of a sudden they come to the payroll department and they get this, and they're like, well, I don't want this one, you know, give me back the other one. And unfortunately, you can't, because anybody, doesn't matter when they were hired, but anybody who is trying to submit a new W-4 must submit the post-2020 kind of W-4, that mini tax return. Of course, all new hires who are onboarded have to submit the new form. And the third group of people that need to submit the new form are those who claim exemption from withholding. You know, those people that claim exemption from withholding have to be submitting a new form every year. I'm not sure if all employers are aware of that. I hope everyone on today's webinar is aware of that. You can't just make someone exempt from withholding because once upon a time when they were hired, they checked off exempt from withholding. They need to be submitting a new W-4 to you every year by February 16th. And if you don't get a new W-4 claiming exemption from withholding by February 16th, 2021, then you have to begin withholding from them. So that might be something you want to put a stub message and remind employees, or a payroll stuffer, depending on what your payroll service allows you to do. At Viventium, it could be right there on your ESS, on your employee self-service. Anyone who's claiming exemption from withholding could get a reminder that in order to maintain your exempt status, you do need to submit a new W-4 by February 16th. Now, if they're submitting an exempt form, it must be the new form, the long W-4. Any new piece of paper that an employee is handing you about their withholding information, again, I can't stress this enough, even if they're grandfathered and they're, they'll say, well, I was hired before 2020, it doesn't matter. Anytime they submit a new form, it must be this new format. They must use the 2021 form. There's no option to use the old form. So let's take a look and compare the tried and true short form on the left-hand side and this new, relatively new mini tax return that was introduced last year, but that many of your employees may just be coming up against this year. And it's important to understand the differences. First of all, just some editorial differences. It used to say your first name, your social security number. They've shortened that, they've streamlined that, they've made a box for first name, last name, social security number. And there in number 4 of the old form, they had a little caution that if your name differs from the name shown on your social security card, check this box and call Social Security for a replacement card. That's because what's called the ESF, the earnings suspense file of Social Security, is just growing and growing and growing. It's over $1.7 trillion in wages that people are just not getting credit for. And that's because of Social Security name and number mismatches. Meaning when you file the W-2 for your employee, if their name or the spelling of their name is not sufficiently matching, not sufficiently close to the name that appears on their Social Security card where their Social Security number is issued, then the Social Security Administration is not going to be able to post the wages to their account for their benefit on retirement. And when they retire, or when they get close to retirement and begin actually paying attention to their earning statements, they may see years and years of missing wages, and they're sitting there somewhere in a suspense file. One of the main reasons that that happens is because of name and Social Security number mismatches. Sometimes people's last name might change, or they may have a first name change, a legal change, and they just neglect to go to Social Security Administration, and it's not automatically updated. And they need to go to Social Security and get a new card. So that's what line 4 on the old form told them to check the box and get a new card. Well, we have that little note still on the new form over on the right-hand side. Does your name match? They don't ask you to check any box because that checkbox really didn't go anywhere. So I guess they figured it was just kind of silly to check a box. It wasn't going anywhere. But do note a little bit of a new policy on behalf of Social Security. On the old form, it said if your last name differs. This year, starting in 2020, they've actually upped the ante, and it says, does your name match? That means if you have a mismatch in your first, middle, last, or title, any portion of your name. And that really reflects the Social Security's policy to become more aggressive, more proactive, shall we say, in trying to reduce this earnings suspense file and trying to get names and Social Securities to match up. So if any part of the name would be a mismatch, there's a reminder to the employee to do something about it. But the main change we only see when we look at line 3 of the old form. And there used to be 3 marital statuses: single, married, and married, but withhold at a higher single rate. If we look at the new form, in box C, there's still 3 statuses, but they have changed. We have single or married filing separately, Then we have married filing jointly or qualifying widow, widower, which was not on the old form at all. And then we have a third brand new status called head of household. And if you remember when we looked at the table a couple minutes ago, there was a single table, a married table, and head of household, which pre-2020 didn't exist. There was never a separate type of federal tax tables for head of household. What do you check off? Well, if you checked single on the old form, you check single on the new form. If you checked the third box on the old form, married but withhold it single, then you check the first box on the new form, married filing separately. So this is the kind of thing that you can help your employees with. It's not called stepping over the line. If someone comes to you and says, I checked off married but withhold and higher single rate on my old form, and I want to have that same status now, what do I check? That's fine. Go ahead and tell them that's the first box. In other words, box 1 and 3 of the old form correspond to box 1 on the new form. Now, what if someone comes to you and says, I became a widower this year. How do I know if I'm a qualifying widower or widow that I can still check married filing jointly? That is something that I would suggest you not define for them. I would suggest that you direct them to the instructions for Form W-4, where qualifying widower is defined, and have them read that through and determine if they apply, but if they qualify. But to sit down and start, helping them figure out what status they're supposed to have, that's a job for their tax advisor, not for their payroll department. So you wouldn't want to cross that line. But married, the second box will correspond to married filing jointly, generally. That's the second box on the new form. And head of household, well, there again, if someone says, well, how do I know if I'm a head of household? Again, I wouldn't do much more than just point them to what it says right here on the form. Check only if you're unmarried and pay more than half the costs of keeping up a home for yourself and a qualifying individual. What is a qualifying individual? Once again, just be broken record. Take a look here at the instructions to Form W-4 or speak to your tax advisor. And we're not saying this because we're trying to be, difficult with our employees, but we're saying this because it's not safe, it's not secure for you, for your company, to be providing tax advice to your employees. So, yes, technically, how do I use the form? What are the boxes that correspond to the boxes in the old form? Yes, 100%. Advice about what to fill out? No. Number 5 on the old form, total number of allowances you're claiming from the worksheet. That obviously is not going to be on the new W-4 because, as we said, allowances are out the window. There's no such thing anymore as married 4. There's only married. There's no such thing as single 3. There's only single. We don't look at number of allowances anymore, so there's nothing that corresponds to that on the new form. Additional amounts. Sometimes employees want to request a higher amount to be withheld. So that does have a corresponding box on the new form. It's step 4C, extra withholding. That corresponds to line 6 on the old form. And then there seems to be a big lack because in box 7, where it asks for exemption, if an employee says, I'm claiming exemption because I didn't owe any tax last year and I don't anticipate owing any tax this year, so therefore I claim exemption from withholding, you can read through the entire new W-4 and you will not find any place for an employee to claim exemption from withholding. And we'll talk about that toward the end of the webinar. How does an employee now, with using the new form, how do they go about claiming exemption from withholding? Some variants of the W-4, we have the Spanish form, the W-4 SP for your Spanish-speaking employees, has also been revised for 2021 to reflect all the same changes that are contained in the English version, and it's available on the IRS website. That's the W-4 SP. A bit of a surprise that the W-4P, for those of you who may be making distributions from pension plans to former or retired employees, a bit of a surprise that that has not yet been revamped. In 2020, the IRS kept the old form, the old format, and they just included instructions what to do under the new system. They had set 2021 as a goal for revising the W-4P. We can't blame them because coronavirus happened, and we all know that the IRS was extremely burdened, as we all were, implementing all the relief and trying to really hold with all the mandates they were handed by Congress. So we can't blame them, but the W-4P still stays in the old format for those who are doing pension or annuity withholding. And again, for those employees that have questions, well, what if we have multiple jobs or more than one income? They would need to read through these instructions and the general instructions at the top of the form to figure out how they would need to be filling out the form. So now it's time to talk about steps 2, 3, 4, and 5 of the new W-4 of this long one-page form. We went through step 1 pretty carefully. Let's jump in and take a look at the rest of the form. So first of all, I have to say, there are only 2 steps that need to be completed in order for a W-4 to be acceptable and usable by the employer. And that is step 1, where you give employees name and address, social, and their marital status. And step 5, where the employee signs the form. That's all. If an employee gives you a form that has step 1 and step 5 completed, and 2, 3, 4 are blank, you can accept that form. You're obligated to accept that form and to withhold based on the marital status they're giving you. Now, why does it only say optional in step 4 if 2 and 3 are also optional? The answer is I don't know. I have a theory, which I'll explain a little bit later on when we get up to step 4, why they wrote the word optional there. But it's quite clear that 2 and 3 are also optional. The employee does not need to complete them. That said, if the employee does not complete them, they're probably heading for a penalty at the end of the year when they file their taxes. Because if they don't complete 2, 3, and 4, then it's likely that there would be, depending of course on their own situation, but they may be under withheld. And no one wants to be under withheld because it's nice to get a refund at year end. It's no fun to find out the owed tax, especially if it comes along with a penalty. So you do want to encourage, it's like an employee comes to you and says, what's the least information I can put on this form? Well, legally, just step 1 and 5. But if you want to make sure that you're getting withholding that's as accurate as possible and that will stave off any estimate underpayment penalties at year end as much as possible, then encourage your employees to do fill out steps 2, 3, and 4. So the IRS says here, complete steps 2 and 3 and 4 only if they apply to you, otherwise skip. And the first one we meet is step 2, multiple jobs or spouse working. So right away here we see, as I mentioned at the beginning, that kind of trade-off between privacy, complexity, and accuracy of withholding. In order to get the most accurate withholding, we need to know if your employee is working more than one job. Or the other way, if they're married filing jointly and their spouse is working 1 or more jobs. Why is that? Why is that important to know? So it has something to do with a term that I think you're all familiar with, and that term is standard deduction. When you file your tax return, you get a standard deduction that's a function of your marital status, and you get to deduct that from your taxable income and reach another, you get to deduct that from your adjusted gross income, your AGI, and get to a taxable amount, right? So it's something that reduces your income, reduces your tax. Your standard deduction is built in to payroll withholding tables. Those tables that we looked at before with all the rates, the 2 systems, they have a standard deduction built in, which means if you have 1 job, then the withholding is going to be basically accurate based on your marital status because the standard deduction is built in. What happens though, let's put on our accounting hats a minute and think, what happens if you have more than 1 job? Well, each employer obviously is going to use those same tables. So each employer is taking the standard deduction into account, which means you're getting withheld as though you were going to be able to claim 2 standard deductions on your tax return. And of course, you're only 1 person, you're only going to get 1 standard deduction, or your unit, if you're a married filing jointly, you're only going to get that married filing jointly standard deduction 1 time, not 2 times. That means on one of your jobs, you're going to be under withheld, or perhaps on both. And certainly if your spouse is working, and they're also getting the standard deduction factored in so that the withholding is lower, then quite clearly you're going to be under withheld. And therefore, you need to have an extra, if you're working multiple jobs or your spouse also works, your withholding needs to be higher in order to prevent you from being under withheld. Now, how much higher? How do we know? So the IRS gave employees 3 choices. And this way they can't say, well, I'm being forced to disclose information that compromises my privacy or my relationship with my employer. I don't want them to know I have another job. That's fine. The IRS got that. They invited all these comments, and we went around and around between the employer community and the IRS, back and forth. And therefore, they gave 3 options, A, B, and C in step 2. And you can explain this to your employees. A, B, and C are mutually exclusive. You pick only one and not any others. A is the most private. In other words, the employee has to disclose the least information about themselves. It's also the most accurate, but it has certain disadvantages. We'll see. B is roughly accurate and somewhat less private. And C is the least private, the most disclosure. It's also the simplest, least complex, and it's also the least accurate. So let's take a look. A, which is the most private and the most accurate, directs employees to go to irs.gov and use a tax estimator, a calculator, without telling their employer anything. Just put in all your jobs, put in all your income, all your information, and we at the IRS will tell you how much you want to increase your withholding by. And the bottom line of using that calculator will be an additional withholding amount to go put down below in line 4C, which we'll get to for additional withholding. Your employer doesn't have to know why you have additional withholding. Is it because you have another job? Is it because your spouse is working 5 jobs? Is it because you have income from renting out real estate? Is it because you have other, gambling winnings? We don't know. Your employer doesn't have to know. All the employer knows is you're putting down an amount for additional withholding, just like you would have if you had the pre-2020 form. Doesn't know why. So it is the most private. It's the most accurate because the IRS is going to ask you for complete information and give you an accurate feedback of how much to increase your withholding by. On the other hand, it is not necessarily the simplest. It's almost like doing a mini tax process with the IRS. And some employees may find it very daunting. They may say, this is getting too complicated for me. I'm not a tax preparer. They're asking me all kinds of questions here on this website. Some people may be concerned about the security of putting their financial, even though it's anonymous, you don't put your name, but maybe they're afraid hackers can pick up their IP address and somehow trace them, they don't, or perhaps they're afraid the IRS will maintain information about them, which they don't, but they may, people may be concerned about using that IRS calculator. Some people may not have online access. They may not be computer people. They just, I don't want to use a calculator. What other options can you offer me? I get it. I know this is private. I know this is accurate, but for me, it's too complex. I want something simpler. Well, you could try option B. And in option B, the IRS says you don't have to use any online calculators. You can just use a good old worksheet that we're going to provide in the instructions to Form W-4. And that worksheet was going to help you determine how much to put as additional withholding in step 4C, manual worksheet. Okay, so that on the one hand is still pretty private because you're just putting down to your employer what additional amount you want withheld. You're not saying why. He doesn't know that you have a second job. It couldn't, you're just putting an amount down. But as the IRS says here, it will give you roughly accurate withholding. It won't be as accurate as what you would get if you use the website. What does it look like, this multiple job system? Well, if you go to the multiple jobs worksheet, they have something called a multiple job chart. And right away, people may say, oh, no, this is not for me, too complex. But if they come to you for assistance, you can help them. This is just technical. They may not want to come to you with this information, but if they do, you can help them. So first of all, it would go by the status, married filing jointly, single married filing separately, etc. And you would take, if there are only 2 jobs, let's say, you would take the higher job and find the range that the salary fits into. So let's say it's $65,000, the higher paying job. So you would be here in the $60,000 to $69,000 line on your vertical axis over here. Then you take the second job, the lower paying job, let's say it's $30,000, and you find it on the horizontal axis going across, 30,000, here you are. And you find the intersection of the lower paying job with the higher paying job. And the amount right there, in this case, it's $3,360. That amount is the annual additional amount to withhold. Now, of course, it has to be deannualized because the additional amount to withhold is a pay period. That will all be done on the multiple job worksheet, but that would be how to figure out the additional withholding without going to an IRS calculator. What if there's more than two? What if there's 3 jobs? So again, the IRS says, fine, you do a 2-step process. Take the 2 highest jobs, the highest one on the left side, the second highest going on the top, find the intersection, write that number down, put it aside. Now put the 2 highest paying jobs together and find the total along the left side, and then the 3rd job across the top, find the intersection there, add those 2 intersections together, the one that you had from just the 2 highest jobs, and now the one when you did all 3, add them together, and that's your annual additional amount to withhold. And that's what you would deannualize and put down on line 4C. Now, I could hear you saying to yourselves, and I could hear a lot of employees saying to themselves, this is not simpler. This is not simple. This is just not simple at all. Forget it. I'm not doing this either. I'd rather go back and use the IRS calculator, but I don't want to do that either. So is there anything that's just simple that I could just get higher withholding so that I won't have to face a penalty, but without all of this? So the IRS says, yeah, we get you. You have option C. Option C is what we call the magical box. And that can be used if there's only 2 jobs, whether it's the employee's 2 jobs or they have 1 and their spouse has 1. But if you have only 2 jobs, you may check this box, the magic box. And you have to do that on your W-4 for the other job as well. So we kind of joke in the payroll community that one of the side benefits of this whole legislation, the Tax Cuts and Jobs Act, was that it was kind of a social benefit that spouses actually have to talk to each other and communicate about their earnings and coordinate with each other. So maybe that was like a hidden intent of Congress there. But seriously, it does require coordination on the part of the 2 job earners, the part of the 2 workers, that they're going to have to both check the magic box. In order to get it to work, they're going to have to both check the magic box on 2C. And this option works if both jobs have roughly similar pay. Otherwise, they may end up being over withheld. But okay, over withheld is, that's the lesser of the 2 evils. Over withheld, they'll at least get the money back. Better over than under. So by checking this magic box, something is going to happen. What happens if they check this magic box? This magic box is basically a signal to you, the employer, to use the higher set of tables. So if you remember back, there were 2 sets of tables. One was for pre-2020 forms or post-2020 forms if the magic box is not checked. And the other set is for post-2020 forms where this magic box is checked. It's higher withholding. It means more money is going to be withheld. Now, it's not going to be all that accurate because we don't know exactly how much the second job is, but it will do some type of an estimate that the IRS put together, and it will withhold additional tax. It'll over withhold, it'll over assume, and just to make sure they're safe and they won't be under withheld. Those are the 3 options. A, the most accurate and the most private. B, a little bit less accurate, still private, and some people may see it as either more or less complex. And C, which is the simplest of all, not complex at all, just check the box, but it is, not only is it the most inaccurate, it's also the least private, because when you think about it, if an employee checks off this box, what's he telling you? He's telling you that he's working another job or his spouse is working a job. Not everybody's anxious to tell their employers about what's going on in their private life. So it's the least private, but it's the simplest. And no one's obligated to check it. There's other options. Interestingly enough, the remaining steps are complete, 3 and 4 are to be completed only for one of the jobs. And it should be, to be most accurate, you should do it for the highest paying job. So now let's just talk about what that means to you as an employer. Whenever an employee has a major change in their financial situation, they'll usually submit a new W-4 to change their withholding to more accurately reflect their financial situation. However, sometimes if they're the higher paying job and their spouse has a change, now under this new system, they may actually want to change their own W-4, because since they're the higher paying job, they're the ones claiming all this extra step 3 and step 4 information. And even if someone who's not part of your company, their spouse, has a change, your employee may feel the need to revise their information. So you may actually see, and perhaps you've already seen in 2020, you may actually see an increase in W-4s that are being submitted to you in order to, for employees to get their withholding more accurate. It's gonna be a higher volume of changes to W-4s. Now, what are step 3 and step 4 about? Well, step 3 says claim dependents. Now, whoa, your employees are going to say to you, I thought you just told me that there's no more such thing as claiming dependents. So we're finished with that. There's no dependent exemptions anymore. So you have to explain this to them. It's true. There are no dependent exemptions anymore. There's no more withholding allowances anymore. There is, though, a concept on the Form 1040 called the child tax credit. For qualifying children under the age of 17, you can get up to $2,000 as a tax credit against tax liability, or up to $1,400 as a refundable tax credit. And you can also, even if you don't have a qualifying child under age 17, but you have other dependents, you can get up to $500 for each of those dependents as a refundable credit. Where did that find expression on this mini tax form that the W-4 has become? Right here in step 3. If your total income is less than $400,000 for married, filing jointly, then you take the number of your qualifying children under age 17 times $2,000 and put that dollar amount on the line. And again, I would not get into a definition of qualifying children with your employees. Direct them to the instructions of the W-4 or the 1040 or their tax provider to figure out which of their children. They'll say, well, what if it's a foster? What if it's an adopted child? What if it's, don't get into that with them, just send them to the instructions. You can just tell them technically what to do here. Multiply their number of qualifying kids under age 17 by $2,000, put the number down, and if they have other qualifying dependents, multiply by 500, put that number down, add up those two numbers and put it on line 3. Now, we've seen that some software packages have made a compliance error, and they are validating and they're checking these electronic W-4s and only allowing line 3 to be a multiple of $500. Meaning if you try to enter $2,600, it will not accept the number. Okay, that's wrong, that's mistaken. Because it's based on a superficial reading, obviously, of the form, but if someone hasn't been sufficiently involved in the development of the instructions in the form and the process, they're missing the point. What the IRS has said is that we're calling step 3 claim dependence, but sometimes employees can have other kinds of credits. For example, a foreign tax credit or some of the education credits, and they want to claim those as well because they want, those will reduce their withholding. If they have all this extra tax reduction coming to them, why should they have all the withholding? They could get less withheld, they could get a higher net pay. And so the IRS has said if you have other types of tax credits, you can put them here into step 3. And on line 1, you're just going to do qualifying children, and then line 2, you're just going to put qualifying dependents. And then we didn't give you a line for other credits. I think it would have been a good idea if they did, but just add it in. So if, let's say someone has 1 qualifying child, so they would put $2,000 over here on this line on the left. And let's say they had no qualifying dependents, but let's say they had an education credit of $200. So they would take the 2,000 plus 200, and on line 3, they would write 2,200. Line 3 does not have to be a multiple of $500. Okay, so if you're using one of those providers or one of the software packages that's doing that, you probably want to reach out to your provider and point that out to them and see if they can bring their offering into compliance. You do have to be able to accept any kind of dollar amount. And let's say someone had no qualifying children at all or dependents, but they did have a $400 Hope credit or an education credit, they could just put that $400 here, and that's fine. That's perfectly acceptable. And that will decrease their withholding. It will increase their net pay. What about line 4? Let's look and continue the form over here. Step 4. Step 4 says optional. And like I mentioned before, steps 2 and 3 are also optional. I personally have a theory about why the IRS wrote optional on this form, and I think you'll agree with me. Look at the first line in step 4. Look at A. It says other income not from jobs. So they're basically telling you, tell your employer about any type of unearned income you may have, interest, dividends, rental, farm earnings, and K1, Schedule K1, partnership earnings, and any other income, any other unearned income. Here we're not talking about a second job. Here we took care of that above in step 2. But any other unearned income that you want to do withholding from payroll, put down that other income here on line 4A. People are going to take a look at this and they're going to say, what? You want me to tell my employer about all the types of income I have? Are you bananas? So therefore, I think the IRS kind of like stave off those extreme reactions. Put the word optional here, even though 2 and 3 are also optional, but I think they really wanted to just put it up there in bold so people shouldn't get scared. If you don't want to fill this out, you don't have to. This is just to help you if you want your withholding to be more accurate. There are other ways to have taxes withheld from your unearned income. You can have it withheld at the source by the bank. You can request withholding from your investment company, wherever. It doesn't have to. You can pay an estimated tax payments. You can make 1040-ES payments, to the IRS throughout the year. It doesn't have to go through payroll. However, if you would like withholding on your unearned income to be done through payroll, you can do it by putting that other income here. That's an annual amount on line 4A. 4B is if you have itemized deductions or additional deductions that are not included in your standard deduction. And if you do, the IRS is going to direct you to the instructions to use a deductions worksheet. You're going to put down an estimate of your itemized deductions, like home mortgage interest, charitable contributions, SALT, state and local taxes, up to a certain amount, medical. Now, that would go on line 1. That's what you'd be itemizing. And line 2 would be your standard deduction. Remember, we said before, your standard deduction is built in to your tax withholding tables. So you won't have to worry about this if your itemized deductions are higher than the standard. If it's same amount as the standard, that's built in already. So line 3 says if line 1 is greater than line 2, meaning if your itemized deductions have an excess over a standard deduction. Now, so far, everything I'm saying now, you could say to your employees. Just as a best practice tip, that's just technical. Now, if they're going to start asking you, well, what qualifies? I heard there's an expansion of charitable deductions because of COVID-19 relief. That's whoa. That's like way. That's already, talk to your tax provider. But just to just step them through this worksheet and basically just, explain to them what it's saying here without getting into definitions, that I would consider, still within the of course, every company will make its own decision how far they want to go. But you may have employees who really understand their stuff well, and they come to you just to say, I just want to confirm, is this right? So you want to be knowledgeable about this as a support to your employees. So any excess of your itemized deductions over your standard goes on line 3. And then we have additional types of deductions like IRA contributions, student loan interest, that are not itemized deductions, but might still reduce an employee's tax liability at year end. So they can enter those on line 4 and add those 2 lines together. And then that's the amount that they report up here on line 4B as deductions. The line A and B move in opposite directions. If you report other income, that will increase your withholding and decrease your net pay on line 4A. Whereas on line 4B, if you're reporting all these deductions, excess of itemized deductions over standard plus other kinds of deductions, that will decrease your withholding, thereby increasing your net pay. And then we get down to line C, extra withholding. As we mentioned, that corresponds to the additional amount to withhold that used to be on the old form on line 6. And that's flowing through either from the IRS calculator, if you chose 2A, or from the multiple job worksheet, if you chose 2B, or it could be some amount that your accountant, that the employee's accountant told them to put down, or the employee calculated to put down. It's just an additional amount that they want your payroll system to be calculating for them when they do payroll. Now, unfortunately, and this may lead to a lot of confusion, this was something the IRS did not listen to our comments about. Line 4C is a pay period amount, whereas lines 3 is step 3, and line 4A, 4B, they've all been annual amounts. 4C is a pay period. So that means if you get a W-4 where there's like and I'm sure employees are going to get mixed up about this. If you get a 4C that says like $10,000, you can be quite sure that they're not looking for $10,000 most of the time, not looking for $10,000 to be withheld each pay period. They put down they figured everything else is annual. Here I put annual too. So you may want to ask employees to check the accuracy of their line 4C if it looks unreasonable. Step 5 is mandatory. It must be a signed form. And at the bottom, employers only, that information is only filled out if you need to be submitting the W-4 to the IRS, which is the exception rather than the rule, or if you're using this for state new hire reporting and they need the beginning of employment of the employee. What about those employees who are still under the pre-2020 W-4s? They haven't given you a new W-4. And they don't need to. They've been working since 2001 and their W-4 hasn't changed. Okay, well, you can still accommodate them. The IRS gives an example, gives a method to accommodate them. We'll work through an example here that I wrote up for you. Let's say someone is $800 weekly and they're claiming married to on their pre-2020 W-4. So you just do the old-fashioned annualize the wage, and then you can still use, the IRS has said if someone's using a pre-2020, you use $4,300 per allowance. So if they're married in two, it'd be $8,600. You get down to the adjusted annual wage by subtracting the allowances from just the old way we used to do it. And then you would go over to the charts and you're going to use the left-hand chart. These are the charts we saw before. This is for employees who have W-2s from pre-2020. 2019 or earlier. And then you just find the bracket that you're falling into and calculate the tax to withhold. So $4,300 is the magic number. Of course, for those of you who use Viventium, this is all transparent to you. As we'll soon see when my colleague Malka will show you some of our screens. You don't have to worry about this, but anyone who's doing manual calculations, 4,300 is the magic number for 2021 to use for allowances for those employees who still have their old forms. And as I mentioned at the beginning, what about those employees who claim exempt from withholding, exemption from withholding? There is no longer a checkbox. There is no longer a certification, or at least one that's spelled out. They're just, according to the IRS, supposed to write the word exempt in the blank space under line 4C. And by doing so, they are certifying that A, they had no tax liability in 2020, and B, they do not anticipate having any tax liability in 2021. And for those of you using electronic W-4 calculations, you need to have, a system that collects W-4s electronically. You need to have a provision there that when an employee checks off exempt from withholding, they have to certify those two conditions on the electronic system as well. Those who have NRAs, non-resident aliens, so as you can guess, there are two tables. There's always an amount that you have to add on to the taxable wage before you begin the tax calculation. It depends. If someone's using a pre-2020 W-4, they use the left-hand tables. And these can all be found in IRS Publication 15T. I'll share the link with you in a little while. And for those who are using post-2020 forms, these are the 2021 amounts to add. And again, they would write in NRA in that space under line 4C. And now I'd like to invite Malka to actually show you, for those of you who were with us at Viventium, these screens may be somewhat familiar. And for those of you who are considering Viventium, you'll get a chance to see just how simple it is to translate all of these new data fields into Viventium system.
Okay, thank you, Yonina. A lot of information there. So let's take a look at Viventium's user interface and how you would take all that information from your employee's W-4 and capture that in Viventium. So the screen in front of you is the tax page of the new hire section in Viventium. And as you can see towards the middle of the page, there is a checkbox for the 2020 W-4. So this checkbox is important because once this is checked, this is going to give you all the options you need to be able to capture all the W-4 information for a W-4 from 2020 or future years. Now, obviously, if you're hiring someone now, the new employee must use a W-4 from 2021 now or later. So this checkbox is automatically going to be checked and grayed out. But you might have an old employee who has a pre-2020 W-4, and if they want to make any changes, they're going to give you one of the new forms, and then you would just go in here and check this box. So let's take a look at how each of the different sections of the W-4 correlate to the Viventium user interface. So as Yonina just explained in step 2, that is where we find the multiple jobs checkbox. So if an employee has multiple jobs or their spouse works and you find that they have checked off that box in step 2, in Viventium, there is also a multiple jobs checkbox and that box would be checked. Moving on to step 3 is where an employee can claim dependent or other credits. So if an amount is entered on line 3, then that amount would be entered into the dependent credit field in Viventium. And remember, this is an annual amount. Moving to step 4, on line 4A is where an employee can choose to enter any other income that they have other from their jobs that they want to have in the calculation so they don't end up owing taxes on it at the end of the year. So if they choose to do that and you have some amounts in line 4A, those would be entered in the other income field in Viventium. Again, an annual amount. And then moving on to line 4B. Line 4B is where an employee would enter any deductions that they want to claim other than the standard deduction, and that would be entered in the deductions field in Viventium. And again, this is an annual amount. And then finally on line 4C, if an employee decides they need extra withholding, they would enter it on line 4C, again, per pay period amount. And that would be entered in the Viventium user interface in the additional amount field. And lastly, if you do get a W-4 that show that the employee wrote in exempt in the space at the bottom of step 4, then what that would mean in Viventium is you would need to check off the don't calculate checkbox. Now this is different than the exempt option, which you see on the right-hand side of this page. The exempt option means that the employee's wages are not subject to withholding, and box 1 of the W-2 would be blank. When an employee writes an exempt in the bottom of step 4 on their W-4, they don't mean that they want box 1 of the W-2 to be blank. Their wages are subject to withholding. It's just that they didn't have any withholding last year and they don't expect to have any withholding this year. So the wages are reported, but there's just no withholding necessary. And once everything's entered, you'd go ahead and save that employee's profile. And as you can see here as an example, John Doe claimed a $4,000 dependent credit. He selected the multiple jobs checkbox here. And of course, if he ever wanted to make any changes, he can go ahead and submit a new W-4, and then the employer can come in here and edit the Viventium site accordingly. So that's just a quick look at our user interface and how it can capture all the information that an employee may put on the W-4. So Yonina, I am going to send this back to you to wrap things up.
Thank you so much, Malka. The Viventium system is seamless, it's intuitive, and it's just a pleasure to use. I love seeing these screenshots because they're just, they're just indicative of just how, how I think the word is elegant, if you can use that about payroll software, the Viventium interface is. As promised, here you have some really useful resources that you can share with your colleagues and with your employees as appropriate. First of all, Viventium resources. We have a quite comprehensive blog that was published at the beginning of this whole thing when the system was revised at the beginning of 2020. It explains the whole face of federal tax withholding. So if you want a written review of our content today, you go ahead and find it right there. And there's also a video or podcast that you can tune into on Viventium's site or channel. So depending on how you like to learn, you have both options available to you. In terms of the form itself, there you have a link to the W-4 for 2021. And as I mentioned, publication 15T, which is where you'll find the withholding tables, as well as a worksheet for those employees who are still using those pre-2020 forms. So I want to go ahead and thank you on behalf of myself and Malka for joining us today to learn about withholding in 2020. And I want to invite you to visit us frequently at Viventium.com, and especially at our HCM software information page, to learn more about what Viventium can do, both for our current clients, learn more about our additional services, and for those of you who are thinking of joining the Viventium family, find out about what Viventium can do to streamline and make your payroll process easier and more enjoyable. And thank you all very much today. Have a great day.